Welcome to the latest episode of Quest for Twice. Today is February 24th. I'm going to cover the recent two earning updates from Energy Transfer and Upstart. So for Energy Transfer, there has been a few changes to the financial pictures. The main driver was the recent acquisition of Enable Midstream. So if we look at the Q4 results at the top of this table, the current debt level is $50 billion and the market cap is $30.3 billion. So those are significant increase from previous quarter end numbers. The reason is because of the absorption of Enable Midstream. 2021 EBITDA came in at about $13 billion. That's significantly more than $10.5 billion in 2020. The main reason, as I mentioned earlier, was the 2.2 windfall from the winter storm Uri. Energy Transfer gave an outlook of $12 billion EBITDA in 2022. So if we take away the impact from a winter storm, then that's an increase from 2021. However, as I mentioned, Energy Transfer bought Enable Midstream. So we should see an EBITDA increase because of the expenditure to buy a new company. So the 2021 DCF came in at $8.2 billion. Although Energy Transfer did not give information about the 2022 DCF outlook, we can extrapolate based on the EBITDA outlook. So that's $1 billion less than 2021. So the DCF roughly will be also $1 billion less and should come in a little over $7 billion. Another significant update from Energy Transfer is the significant increase in 2022 capex to about $1.75 billion. That's a little over $1 billion increase from its previous guidance. Most of the increase was driven by additional opportunities from Enable Midstream, including a 42-inch Gulf Run natural gas pipeline that should complete according to management in this year. And also, there was about $0.2 billion of capex shifting from 2021 to 2022. Energy Transfer also announced 15% dividend increase going forward. That will take its full year dividend payout to be about $2.25 billion. And at the current market cap, that's about 7.2%. So at the current enterprise value of $80.3 billion divided by 2022 EBITDA of $12 billion gives us 6.7. I consider that as undervalued. Another way to look at the valuation is, as I mentioned earlier, 2022 DCF should come in about 7 or a little higher. Then the forward dividend plus 2022 capex comes in around $4 billion together. So there will be $3 billion of free cash flow after capex and dividend payout. The management stated that the priority using the extra cash is to continue to increase dividend, pay down debt, and look for capital opportunities. It's a little disappointing to me because, in my opinion, the best way to spend the actual cash is to buy back stocks, buy back its outstanding units, because that will reduce the future dividend burden. So apparently the management disagree with my thinking. Nevertheless, as long as the management does not destroy value by using the free cash flow to overpay for new companies or to waste on wrong capital projects, then that will still be able to pay down debt and increase dividend. That's a reasonable use of free cash flow. In summary, I think Energy Transfer is undervalued at this price point. Upstart also reported its earnings last week. Its Q4 revenue came in very strong, increased by about 252% year on year. There is no sign of slowing down from its explosive growth in Q3 and Q2 last year. The management also gave guidance about 2022 about $1.4 billion. So if we look at the bottom left graph, then we can see a very nice revenue growth for about 85% CAGR. Revenue in 2020 was below trend because of the pandemic. So the revenue in 2021 was above trend, and probably due to a catch-up, shifting the revenue from 2020 to 2021. However, management also attributed that above trend growth to model and algorithm upgrade. If that's the case, then I think Upstart will have the potential to exceed its guidance of 1.4 billion revenue in this year, because there will be more demand for auto loans and personal loans with the government stimulus winding down, and also hopefully the bottleneck from semiconductors will ease, and there will be more automobile supplied and purchased. On the other hand, with the government stimulus winding down, the default rate is forecasted to rise. And Upstart management mentioned that they have already accounted that in their model. So we'll see if they are correct. So will the fast growth continue? Let's look at the growth opportunities for Upstart. In the short term, as I mentioned earlier, if they can do better marketing, then they will reach more potential customers. So as a recent Q4 update, their banking partners have grew to 38 from comparing to 31 in Q3 and 10 in the Q3 2020. So that's a nice growth. And also, better conversion will increase its loan transactions and revenue. So Q4, the conversion was 24% compared to 23% in Q3 and 17 and 15% a year ago in the same periods. So the conversion rate is trending in the right direction. But more importantly, the management gave an outlook of auto loan transaction of $1.5 billion in 2022. That's supported by the dealer rooftop statistics it presents in the earning update. So at the end of Q4 last year, there were 410 dealers using the Upstart software, compared to 111 1 year ago. That's more than tripled. Actually, it more than doubled from Q2 2021 at 199 dealers. Because the auto loan market is so big, previously it's stated as $672 billion. That's about 10 times as larger as a personal loan. And the current trajectory and confidence from the management in the auto loan market is very strong. So the short-term and the mid-term opportunity looks great for growth. So a quick update on the moat analysis. As I mentioned, Upstart is continuing to add its banking customers to 38 from 12 1 year ago. So the network effect may happen down the road with more and more banking customers and borrowers going onto its platform. And also, I think the switching cost will become larger with its Prodigy software adopted by the dealers. It will give Upstart a very strong distribution channel of its auto loan products. So the 2021 ROIC came in at 68%. That's just a mind-boggling number of how strong it is. As I mentioned earlier, that may be attributed to the revenue shift from 2020 to 2021. However, if we look at the numbers before the pandemic, its ROIC was between 25 to 35%. That's also extremely strong. So that's also a very strong indication of its moat. I have no update on the threats and the opportunities I presented in the deep dive in January. So let's take a look at the valuation. As I mentioned earlier, Upstart was a meme stock in last year. So at $114 per share, its price over sales ratio is 7.2. If we use the $1.4 billion revenue outlook for 2022, and that's compared with the multiple of 5 for Equifax 5-year average. Because of the recent strong growth for Equifax, 5 was actually considered undervalued for a company with strong growth. Another way to look at it is the price over sales ratio for Upstart was 13.6 at the end of 2020. So despite the large stock price increase, its price over sales ratio actually came down if we look at the forward sales guidance. So I would say at the current price level, there is a very limited risk of owning Upstart stock. The duration to parity stands around 4, so it takes 4 years for the sales to catch up to its market cap. That's a low number for a high growth company. As I mentioned before, I think its future market cap may reach 100 billion if its sales can reach 16 billion. And its current market cap is about $10 billion, so a potential 10-bagger. Of course, that's a very big if, that if Upstart can execute its growth plan in the auto loan and the mortgage as well as a small business loan space. So despite its high risk, I think there is also a potentially very high reward for its stock owners. This wraps up the current episode of Quest for Twice. Until next time, happy investing.